Now, Todd, it's interesting because for many of these strategies, they're not straight up S&P 500 index following strategies, not even ones that are sector specific for the S&P 500. They are ones that are, I wouldn't call them frontier type assets, but they're ones where they are relatively new to the broader range of retail investors out there and even some institutional investors on the RIA front. From a fee perspective, Anna mentioned how the low cost theme has been something that they've seen develop quite a bit over the course of this year. How much is that fee story resonate with traders and investors when it comes to higher, say, volatility or higher potential return type instruments like the ones we had just talked about?
So Anna covered it well. There's two ends of the spectrum. There's the low cost and crowd, people who are very fee conscious. And so SPYM, which is one of the S&P 500 ETFs that State Street offers, is about to cross a key milestone of $100 billion. It's on the cusp of that. It's seen strong inflows in 2025. So have some other S&P 500 based products from Vanguard and from iShares. But investors are willing to pay a little bit more for the complement to their portfolio. So Bitcoin oriented ETFs are priced at a premium to what you'd find for S&P 500 based products. We've seen the private credit based products, again, a similar higher premium because you're providing access to an area of the marketplace that is harder to obtain. And so the last time I was on with you, we were talking about the Simplify Private Credit ETF, PCR. That's another example of ETFs that are helping to innovate within this space. There's room for both low cost products and products that are a little bit more complicated, offering you a unique area. And then of course, there's actively managed ETFs, some of which charge a higher premium.
Now, Todd, to follow up on that point, at what point right now do you feel as though we are in terms of the game, innings, so to speak, for just how much investors and traders in some of these newer types of ETF products with newer strategies will be willing to look beyond some of the basis points that are charged in fees towards the underlying strategies and the performance? And when will we get to a point? How far are we away from a point where investors are going to be saying, hey, you know what, for some of these cryptocurrency type tracking products, for some of these private credit products, I really am going to pay attention to just how much in fees I'm paying that impact my return overall?
So I think if it's a relatively simple strategy tied to an index you're familiar with, or it's not even an index. So S&P 500 or gold, GLDM is among the cheapest of those gold ETFs that's gaining traction. Fees matter. For other areas and other asset classes, thematic strategies, for example, come to mind. We've seen strong interest in thematic ETFs that are charging 50 basis points, 65, 75 basis points. NUKZ is a nuclear energy ETF, for example, that has seen a lot of popularity this year. And it's benefiting from that AI trend, but a more complementary way of getting exposure. So I think fees matter if you're building a portfolio of core strategies and nothing else. If you're complementing that with other areas, alternatives, thematic, even actively managed strategies, it matters what's inside the portfolio much more than just how cheap this portfolio is.